Canada's real estate market is booming. In the past 3 years, real estate prices in Canada have risen by a whopping 30%. In fact, in 2015, Canada's real estate market had a record-breaking year. This is mainly because of Canada's robust economy and low mortgage rates. So, if you are a non-resident interested in investing in the Canadian real estate market, here are the top 5 tax tips that will help you save tax and avoid trouble from the Canada Revenue Agency. Number 1, know your tax obligations. As a non-resident earning rental income from a Canadian property, you are required by the CRA to remit a withholding tax amounting to 25% of the gross rental income. Number 2, receive a refund by filing a Section 216 tax return. Once you've remitted tax at 25% of your gross rental income, consider filing a Section 216 return to receive a refund of the tax paid for the year. The Section 216 return takes into account the gross income and expenses incurred for the year and allows you to be taxed on the net rental income earned. The refund is calculated by taking the difference between the total tax payable and the non-resident tax already remitted for the year. Number 3, keep proof of all of your expenses. You can claim all of the relevant expenses incurred in respect of earning rental income. This will help you reduce your net profit and therefore increases your tax refund. You should also keep vouchers in respect of any capital expenditures, such as a roof change, as this will help you increase the cost of your rental property that can be depreciated over time. Number 4, consider maximizing your refund by claiming depreciation. To maximize your refund, you can depreciate the building portion of your rental property. The benefit of this is that it helps reduce your taxable rental income. In the initial years of renting, the depreciation claimed may match the net rental income, and therefore you may get a refund that totals the amount of tax that you remitted to the CRA for the year. However, if you're going to sell your rental property in the near future, you may not want to depreciate it. This is because depreciation claimed will be recaptured or included in your taxable income in the year of sale. If you do not wish to depreciate the building portion of your rental property, you can instead consider depreciating furniture, fixtures, and so on. This can help reduce your net rental income. And if you do decide to sell your property, there won't be any recapture of depreciation previously claimed. Number 5, reducing the tax you remit by filing Form NR6. The NR6 reports the estimated monthly amount of gross rental income and expenses you expect to incur during the year. If approved by the CRA, you can remit the non-resident tax at 25% of the net rental income instead of the gross amount. For example, assume that the gross rent collected for the year is $10,000 and expenses incurred are $6,000, leaving a profit of $4,000. With an approved NR6 waiver, what's the amount of tax you have to pay? If the NR6 is approved, the tax would be only $1,000 instead of $2,500. Be sure to file your NR6 and get it approved by the CRA before your first rent payment is due. Please note, in order to qualify for an NR6 waiver, you must appoint an agent who is a Canadian resident. This can be a property manager or a family member. The agent is expected to act on your behalf and make the monthly tax remittance. Also, it is important to note that the agent must continue remitting at the 25% rate of gross rents collected until the NR6 is approved by the CRA in writing. These are the top 5 tax tips which will help you maximize your benefit of investing in the Canadian real estate market. Thanks for watching. Please remember to like, comment, and subscribe. You can also follow us on Facebook and Twitter for more tax tips. See you next time.